Hello and welcome to a brand new episode of Smart Money. Today we discuss one important financial goal for millennials, which is educating your children. Now, this discussion assumes more importance because of the rise in education inflation. The rate of inflation in education has been significantly higher at around 11 to 12% compared to consumer price inflation at 6%, implying that education costs could double every 6 to 7 years. So how do you plan for your children's education? We have three personal finance experts joining us today. Harshvardhan Roongta, the CFP of Roongta Securities, Prableen Bajpai, the founder of FinFix Research and Analytics, and Harsh Gehlot, the co-founder and CEO of FinEdge, join me on the show. Ladies and gentlemen, thank you so much for joining me. Now, Harshvardhan, let me start with you actually. There is an understanding now of how much it would cost me to send my child, and it's not funny, right? If you want to send your child abroad, this big money that we're looking at. You recently sent your son abroad as well. Just make our viewers understand what is the kind of expense that's involved.
Sonia, this is a very important topic, as you said. It is one of the most important financial goals of any family, because I'll just take one second away from the numbers. Education is it's really the only asset that you're giving to your child, right? So you have to ensure that you are able to fund for that goal for yourself. Secondly, education is a time-bound goal. You cannot say that I don't have the money now, go to college probably 2 years from now. No, that doesn't happen. You need to have the provision for that money right then. Okay, now if you're talking about cost of education overseas, well, in today's time, in present value, it would be approximately a cost that a family would incur for a child studying overseas would be approximately $100,000. So that's about $70,000 to $80,000 is what the university fees.
A year.
That's per annum. That's
okay.
right. So this I'm talking about the undergrad program.
Okay.
So $70,000 to $80,000 would be approximately the cost which the university takes in the form of tuition fees, in terms of accommodation, in terms of some mess, food, etc. And the balance amount, about $20,000 to $30,000, would be the other expenses that a child would incur, which could be like food, which could be like travel and all other things. So yeah, it's about $100,000 that you would estimate in present value. In present terms, in today's times, is the cost per annum for an education overseas.
So today, if I have to send my child abroad, you're looking at 85 to 90 lakhs per annum, which is just basic tuition fee, as well as some travel expenses and food expenses here and there. So there's some heavy planning that needs to be done for that, right?
Yeah, absolutely. So this is the cost I'm talking about. Places like the US, Canada, I'm talking about. Places like these, closer to Asia, I mean, of course, Singapore and all will be slightly lesser. I mean, probably be half in that context. So Singapore would be half of that of US expenses. But nevertheless, I mean, the broader topic that we are going to be focusing upon and talking is about providing for that education. I mean, be it quality education in India or overseas, every family would need to provide for it because there's no choice. If you have children, you have to provide for it. It would happen. So, the ideal time to do it is the moment you have a child in your house. When the child is probably 1 year old or even younger for that matter, it is an expense which is going to come upon you, right? It could be 15 years from now or 20 years from now. It is going to come upon you. So why not plan for it and start saving for it earlier?
Suddenly, I'm so glad that I have only one child and not two children. But no, jokes apart. Harsh Gehlot, weigh in on this. At FinEdge, you manage, I think, 19,000 retail clients across 1,600 cities. I'm sure children's education is a big financial goal for your clients. What is the typical fees that one has to shell out today for education in India? I mean, Harsh spoke about, educating your child abroad. And if you talk about 15 years later, how much will that escalate to given inflation?
Thanks. So there are, I think, two aspects to this fact. And when you talk about, I know a certain small percentage of people will send the people abroad, but a majority of people will get their studies for the children done in India. In that case, there are two aspects to it. One, education in the country itself is changing with a lot more new private institutions coming up, a lot of new colleges coming up, and they're not cheap either. Typically, if I was to take an example today, even if somebody who's doing an engineering course, approximately about 2.5 lakh rupees a year is what a person pays, which comes to about 10 lakh rupees for the entire course. But once again, the problem here is the cost of inflation. If my kid was really small and 5 years old, and I was planning for 15 years, and I put inflation, a double-digit inflation, into the maths, then this number goes up from 10 lakhs to 54 lakh rupees, and that is what you have to be careful about. As education changes, courses will get more and more specialized within the
Oops, okay.
Unlike the Western world, when people are planning for their finances, I think what we have seen with all our clients is people really prioritize children's education. We take that very seriously in the country. That's something which people are very focused upon, and almost 84% of our clients above a certain age group definitely have children's education as a goal for their children.
Okay, so you're saying if I want to educate my child in India, today on an average, it's about 2.5 lakhs, 3 lakhs per year, but that will of course be much more when as my child, grows up after about 10, 15 years. Prableen Bajpai, come in on this. What are the different products that we can invest into for our children?
Hi, Sonia, and absolutely, great insights by Harsh and Harsh. And, to match up to these numbers, huge ask which is there, we do have a lot of products where parents can start investing. We'll divide them into three segments. Number one would be insurance-backed products. So we do have endowment plans, and then we have the ULIPs where, it's a money back and
Okay, I think there's some issue with your video, so I'm just going to come back to you in a bit. Harsh, you want to take that? How do I structure my investments for my child? Because there's so much out there that you can invest into. If you just had to simplify it for us, 1, 2, 3 things that I need to do to invest for my child.
So, well, Sonia, you have to match your investments with what your expectations are in terms of inflation as well. So we just ran the number. You said that education inflation is in the range of 11 to 12%. So if you're saying the cost of educating a child today is X, 1 year later is going to be X plus 12%, right? And if you have a goal which is say probably 10, 15 years down the line, your money has to grow more than inflation rate. Only then you're really making money. So which is the asset class which could possibly give you 12% and above, the possibility of generating that kind of returns? So of course it's going to be equities. However, you cannot put in equities if you're just 2 years away. If your child is 13 years already and you're planning to send the child, you require money at the age of 15, then you cannot put in equities. So there are lot of products that are available to invest into. What you need to be very mindful of is that what is the time horizon that I have left before I need this money. So if that is the case, then you start planning accordingly. What are the different options if you're asking me? One is you can most certainly use equities via mutual funds, of course, through an SIP route. You can plan for your children's education. You have a couple of insurance policies, as what Prableen had highlighted, try to focus upon that, saying that there are certain child-oriented policies which are designed in such a manner which try to take care of children's higher education requirements. So you'll be just very mindful when you're taking these kind of insurance-based investment products, because we've always kind of said insurance is not the best investment opportunity. However, if there is an option, you might want to look at it and evaluate whether it makes sense for you or not.
Okay.
Other than that, government has introduced for the girl child, you have a Sukanya Samriddhi, which is specifically focused on encouraging investments in the name of the girl child. So there are lot of investments. I mean, I know people doing a recurring deposit for that matter, saying that I need to plan for my children's education. So why not a recurring deposit? Small saving deposit. So there are fixed deposits, all that comes under the fixed deposits and the debt instruments. Or on the other hand, you look at planning through a high growth product, which is say mutual funds, equities via mutual funds.
But it's interesting, right? There is a very interesting plate that's coming up on the screen. Where are Indians investing? And it is fascinating to me, despite the markets being at a record high, 35% of Indians are investing in bank deposits, while only 6% Indians are investing in mutual funds. Harsh Gehlot, come in on that. What is the reason for that? And, if you have to educate your child abroad today, do you think that equities is the only route to go, the only way you can properly beat inflation? And if yes, what are the products I need to look at?
So I would think a little differently on this, and I'll answer your question. I think the reason why we have fewer percentage of people investing in equities is because there's a certain amount of fear that my money will be at risk and all of that. Similarly, you have people trading short term, and over there the greed factor takes over. So one where I would vary in terms of my thought process is, one, I don't think taking informed risk is very, very important in this case. You have to go beyond your fear. I don't feel for such long-term goals, which are more than 5, 10, 15 years away, investing in insurance products or FD or PPF will really work in your favor. We must remember that we are talking about a double-digit inflation. That means you have to beat double-digit inflation. And if you talk about endowment plans and PF and FDs, on average, 5.5 to 6.5, 7% is what you would get. You would still not be able to accrue enough at an aggressive rate. So taking informed risk becomes very, very critical. And especially if your goal is 10, 15 years away, you have to allocate funds towards equity. Of course, you can simplify all of that. You can stagger all that money. You can also use this time to, create a corpus by investing on a monthly basis that drastically reduces your risk. And I think the key over here is to have a very clear-cut goal so that takes away that fear, take informed decisions. And if I may use an analogy, it is like a long-term goal is like looking for a long-term relationship. You have to have the right expectations. You have to commit to it. You have to communicate with somebody who can guide you and give you expertise to stay invested. That is the only way you can compound at a higher rate than inflation and meet your goal.
Okay, and keep your expectations low, right? And that's what you do from a long-term relationship also. But no, jokes apart. Yeah, go ahead, Harsh.
In terms of expectations, you can't really expect that, everything is going to be wonderful. There will be tough times. There will be good times. The first fight that you have, you don't pack up your bags and leave the house. When you're committed, you understand what you're getting into, you know what you want, and then you're willing to stick it out. So from that point of view, that is what I mean by expectations.
Absolutely. I think we have Prableen back on board. Prableen, you were telling us about the different kind of products, right? So you talked about ULIPs, but we all know that generally as an investment rule, if you want to be financially prudent, it's better to always keep insurance and investments separate. So take us through what your rationale is and what are the other products that I can look at for my child?
All right, Sonia. So the first one, like I started, was with insurance backed. And I think why these products are picked by product parents is because I think there's sort of an emotional connect in the marketing pitch or the sales pitch, and it is able to appeal to most parents where they feel that, the child's future will be taken care of. One clear good advantage of these products is if the parent who's insured, something happens to the parents, the premium amount keeps going. But as I think in personal finance, we strongly believe that insurance and investment is something that you shouldn't mix, and I call it the don't drink and drive kind of a combination. So when it comes to risk management, have a term plan which is able to cater to all your child's needs. And I think if you're looking at a market-related product, then mutual funds, it is a leaner, simpler, and a more flexible route. The second, of course, structure is the fixed income, because as Indians, we all love fixed income products. And Public Provident Fund and Sukanya Samriddhi, I think both of them are great products. In 15 years, a PPF can give you about 40 lakhs, and with the Sukanya Samriddhi, because the maturity is actually at 21 years. So at 18 years, the corpus would be about, if you're doing that 1.5 lakhs, the corpus would be somewhere around 55 lakhs. So you can take out about 27 lakhs from there. But Sonia, what happens is that as Indians, we are having limited resources. And if we have to commit to a long-term goal, it's best that we look for something which is most efficient. A market-related product like mutual funds, be it through the solution-oriented funds or through regular mutual funds, which can give you somewhere between 12 to 15%, which is, I think, a realistic assumption. The amount that you're committing for that goal reduces. So, for example, if somebody is wanting that today the cost of education is 30 lakhs, let's say for a 4-year course, after 15 years, the same cost would be about 1.64 crores. And if you're taking a 7% product, you need to invest about 53,000 a month. If you're taking a market-related product like mutual funds, even with just 12% return expectations, the ask for investment drops down to 35,000. And I strongly believe with limited resources, Sonia, if that 18,000 can actually be parked aside, that can actually build another 1 crore in those 18 years. Because children are important. Parents tend to jeopardize their own future, which is their retirement corpus, to cater to the education needs. So I think choosing the right product can really help them reach both the goals, so you don't have to sacrifice your future for your child's future.
Absolutely. And there's some really sane advice coming through. We have to take a short commercial break, but don't go anywhere. We'll continue this discussion about how to invest for your children, for their education and future in just moments from now. Stay tuned. Welcome back to Smart Money on CNBC TV18. We're talking about children's education and how you should plan that, because all of us know that it is an expensive affair for sure. If you want to send your child abroad, today you will need at least 85 to 90 lakhs per year to send your child for an undergraduate program. And in India, you will need about 5 to 10 lakhs. So let's talk to our guests and ask them, how do we structure it? Harsh, you tell me first, first of all, do I need to have a separate account for my child where I make my investments? And then how do I structure investments for my child? Harshvardhan.
Okay, so Sonia, you have a 6-year-old.
Yeah.
It's very simple. You take yourself as an example. So you have a 6-year-old. You will first estimate that when are you likely to require. So are you requiring to provide for undergraduation or post-graduation? So you just make up your mind, saying that I have another, say, probably 10 to 12 years before which your child is going to require to pursue undergrad. Okay, because at 18, typically the undergraduation studies start. And then you put a number to this, saying that, okay, I need an X amount of money at his age of 18. Okay, and then you work backwards to say that how much do I need to invest every month to accumulate that kind of corpus. Now, because you have minimum 12 years to your side, most certainly we've understood that fact that you need to beat inflation. Okay, so if you have 12 years to your side, you're going to be investing into products which are having a growth potential, which is equities, right? Which is through mutual funds. You can start an SIP, for that educational goal that you have, and just let it accumulate over a period of 12 years and use it for the education. Now, coming to your question, which you asked was, should you have an investment in his name or in general keep it as a part of the household savings, right? What I'd recommend, if possible, keep an account in his name, so that investments that you're making for children's education, you keep it in your child's name. You're allowed to do an SIP in the child's name. What happens because of this is that you know very clearly that this corpus has been kept aside, and in case of any other requirements that arise in the house, you will not break into it. If it's a part of the common pool in the household investments, and you suddenly think that I need to buy a house, say for example, or you need to buy a car, or you need to go on a holiday, we tend to take money out of it.
Yeah.
And once you take money out of it, I mean, you've jeopardized a very important goal in your family's, financial planning, right? Which is children's education.
Absolutely.
So there is merit when you put money into your child's name. So then at least you know to that extent, this money is untouchable.
Kept aside. Okay, got it. Harsh Gehlot, I want you to come in on this now. Very quickly, if you can tell us, how much should we allocate towards large caps? How much towards mid caps, small caps? What should the allocation be basically for your child?
So I strongly believe that the risk that you should take should not be on your individual personality, but should be on the time horizon of the goal. So to a large extent, where will you put this money will really depend how far ahead are you planning for this goal. So I mean, if your goal is less than 5 years away, really, I think the entire asset class changes. But my assumption is 5 years and more. So if you are the goal is 5 to 7 years away, you would probably want to take slightly lesser risk. You'll be okay with slightly lower returns, but you would probably have an index fund. You would probably have a balanced fund and maybe a flexi cap fund. If your time horizon is between 7 to 10 years, you would increase your allocation towards mid and small caps. So probably add a large and mid cap fund and a small cap fund and a flexi cap fund. 10 years plus, you can get more aggressive. So you can have a higher allocation towards a mid cap and a small cap fund, and maybe leave out a large cap or an index fund and maybe invest in a flexi cap fund. With a 12 to 15 year horizon, it makes a huge difference. The difference between a 12% return and a 14% return is absolutely mind-boggling. So that cannot be ignored. And that is when I talk about taking informed risk, I think the risk profile has to be assigned to the goal, so that you can understand what you're doing, the purpose of it, and how much risk you're taking, and how much are you actually mitigating by investing on a monthly basis. But I don't think for goals that far away, you need to have any other asset class but a nice, simple, easy mutual fund, depending on the time horizon of the goal.
That's very well said. And finally, before we end the discussion, Prableen, a very important, decision. Do you take an education loan? Is that a good option?
Sonia, the decision would actually depend on the situation that you are in. But for a parent, let's say, who haven't really planned much, and the kids' education is just about 2 or 3 years away. So even if you start putting all your yearly bonuses and allocate what you have currently towards the child education, there would be a deficit. And like I said, that you should not jeopardize your own retirement as well, the corpus, because by the time your kids are actually going to college, you are in the 45 to 55 year bracket. So you're also there in your retirement. And if it is coming at the cost of allocating all your retirement corpus towards your child education, then I feel taking an education loan definitely makes a lot of sense, because it is still a productive loan, where till 8 years, the interest component is allowed as a deduction. There is no upper limit on the interest payment which is paid. And, for entities like SBI, they allow you that you can start repayment after 1 year of completing the course. So the liability at that time can be probably divided between the parent and the child. And I think that also bring in some element of responsibility on the child. Maybe the child would actually work harder to get a scholarship so that, the education loan burden can be reduced.
Okay.
So I think it's not a bad idea. Definitely should be thought of.
Okay, teaching your children responsibility is a whole different show. It's another 1 hour special that we have to do, right? But for now, we've run out of time. Thank you so much, Harsh, and Pravleen, for joining me. This is a very, very important part of financial planning. So I thought we must put it out there for our viewers. And thanks a lot for watching Smart Money. Have a great weekend.